What is risk? In investing, it's the chance that your decisions lead to losses instead of gains. But risk isn't inherently bad. It's a natural part of life and every choice we make. Think about it. Choosing to eat a new dish, will you love it, or will it trigger an allergy? Should you cross the street and risk getting run over? Should you approach the girl you've noticed and risk being rejected? Each of these decisions comes with a level of risk. Investing is no different. Take, for example, putting your money in a savings account. Many people think it's a risk-free choice, but there's more to it. Banks insure deposits up to a limit. Beyond that, you're not fully protected. If your bank collapses, you may only get back a portion of your capital. There's also the risk of inflation. Over time, if your savings account doesn't keep up with inflation, your money's buying power decreases. So even if holding cash in the bank is safer than owning a stock, there's still risk involved. Risk is all around us. The key is understanding and managing it, not avoiding it entirely. The prospect of average market return may not seem enticing to you initially. You know what you're doing. You do not have time to waste, right? As a result, you might be tempted to take substantial risks and bet a large portion of your capital on a single opportunity, hoping for a 10x windfall. Wrong. I know because I did it when I was young and lost everything. Listen, the first rule of investing is simple. Don't lose money. You might think that's obvious, but many people overlook this principle: preservation of capital. People often focus too much on the reward and ignore the risks. A common example is penny stocks. These stocks often have huge price fluctuations and may seem like an exciting opportunity for rapid gains. But what most people don't factor in is that these companies often lack a proven track record of profitability, let alone paying dividends. They may be delisted as quickly as they appeared on the market. The risk of failure is high, and the chance of losing everything is very real. The reward might look tempting, but the risk often outweighs it. Even great risk takers, like professional traders, never risk their entire account on a single trade. They limit their exposure to a small portion of their portfolio and use risk management techniques. They know the danger of being wiped out. So, how much risk is right for you? Consider how long it took to build your investment capital. If it took 5 years of hard work and saving, losing it all would mean 5 more years just to get back to where you started. Investments move in cycles. They can span years or even decades. Can you afford to wait? Or might you need to exit mid-cycle and risk a loss? Every investment involves risk, but not all risks are equal. Some offer higher potential rewards, while others could lead to significant losses. The key is striking the right balance. Here are 6 steps to help you manage risk. Step 1. Understand your risk tolerance. Are you comfortable with short-term ups and downs, or do you prefer stability with more gradual growth? When do you need your money back? In 3 months, 12 months, or 10 years? Step 2. Research before investing. Don't chase the next hot stock without understanding the company behind it. Is the company profitable? Does it pay dividends? Is the stock price reflective of the company's underlying value, or is it overpriced and at risk of correction? Step 3. Diversify your portfolio. Spread your investments across different asset classes and sectors. That way, if one investment underperforms, others can balance it out. There's always a chance you could be wrong. Step 4. Adjust for risk. If you're considering a high-risk investment, ask yourself if the potential reward justifies the risk. Start small. You can always increase your exposure as you gain more confidence. Step 5. Monitor and reassess. Regularly review your investments to ensure they align with your risk tolerance. If your situation or goals change, adjust your risk profile accordingly. Step 6. Think long-term. Investing isn't a get-rich-quick scheme. While it can build wealth, it takes time. Focus on long-term growth and avoid the fear of missing out on short-term trends. Investing isn't about avoiding risk, it's about managing it. By understanding the risks involved and adjusting your approach accordingly, you can build a portfolio that balances potential reward with an acceptable level of risk. Have you ever lost a large sum of money? How did it happen? And what did it teach you about risk and reward? What's the riskiest investment decision you've ever made? Did it pay off, or was it a lesson learned? Please leave your responses in the comments. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love. Hit the like button and give it a thumbs up.